Imagine walking into a shopping mall where every single person suddenly starts running toward the same store. Nobody explains why, nobody knows the real reason, but within seconds, more and more people begin running simply because everyone else is. Now ask yourself one question. Would you run with them, or would you first stop and find out what's actually happening? Believe it or not, this is exactly how millions of people invest their money. The moment a stock starts making headlines, social media explodes with success stories. Financial influencers call it the next big opportunity, and suddenly everyone wants to buy it. Very few people stop to ask a simple question. Is this actually a good investment, or am I just following the crowd? Instead of making independent decisions, they let other people's excitement control their own money. And that's exactly why Warren Buffett's rule number 5 is ignore the crowd. Buffett has never believed that popularity makes an investment better. In fact, some of his greatest investment decisions were made when everyone else completely disagreed with him. While most investors look for comfort in following the majority, Buffett looks for facts, logic, and value. Because in the world of investing, being part of the crowd often feels safe. But it doesn't always lead to success. Sometimes the greatest opportunities appear when everyone else is looking in the opposite direction. Have you ever wondered why so many intelligent people end up making the same investing mistakes? The answer isn't that they lack knowledge. It's because human beings are naturally wired to follow the crowd. Thousands of years ago, staying with the group increased our chances of survival. Being alone often meant danger. Even today, that instinct still exists. When we see millions of people buying the same stock, our brain quietly tells us, if everyone is doing it, it must be the right decision. Without realizing it, we stop thinking independently and start borrowing other people's confidence. This is exactly how FOMO, or the fear of missing out, takes control. Imagine watching a stock rise 20%, then 50%, and eventually 100% in just a few months. Every news channel is talking about it. Social media is filled with screenshots of huge profits. Friends and family start asking why you haven't invested yet. At that moment, most people don't buy because they understand the business. They buy because they're afraid of being left behind. The decision is driven by emotion, not logic. Unfortunately, by the time the crowd becomes excited, the biggest gains have often already been made. Warren Buffett has always believed that the market rewards independent thinking, not popular thinking. Rule number 5, ignore the crowd, doesn't mean you should always do the opposite of everyone else. It means you should never make an investment simply because everyone else is making it. Buffett doesn't ask, what is everyone buying today? He asks, what is this business truly worth? That single difference in mindset has protected him from countless emotional decisions throughout his investing career. One of the greatest examples of Warren Buffett's independent thinking came during the 2008 global financial crisis. It was one of the darkest periods in modern financial history. Stock markets around the world were collapsing, major banks were on the verge of failure, and fear had completely taken over investors' minds. Every day, the news predicted more bad times ahead. Millions of people rushed to sell their investments because they believed the market would never recover. To most investors, getting out of the market felt like the safest decision they could make. But while the crowd was selling in panic, Warren Buffett was thinking very differently. Instead of asking, how much lower can the market go? He asked, which great businesses are now available at incredible prices? Buffett understood that fear had pushed many strong companies far below their true value. Rather than following the crowd, he started looking for opportunities. During this period, Berkshire Hathaway invested billions of dollars in companies like Goldman Sachs and later increased investments in other quality businesses when many investors were too afraid to buy. Buffett wasn't ignoring the crisis. He simply refused to let fear make his decisions. This mindset perfectly reflects one of Buffett's most famous quotes: "Be fearful when others are greedy, and greedy when others are fearful." It doesn't mean buying every stock during a market crash. It means staying calm when everyone else is driven by emotion. Buffett knows that markets move in cycles. Fear creates opportunities, and greed creates risk. That's why rule number 5, ignore the crowd, has been one of the biggest reasons behind his long-term success. While most people react to headlines, Buffett reacts to value. And over time, that difference has helped him build one of the greatest investing records in history. Following the crowd always feels comfortable because it removes responsibility from our shoulders. If everyone is buying the same stock, we assume that millions of people can't possibly be wrong. And if the investment fails, we find comfort in saying, "At least I wasn't the only one." That's exactly how emotional investing begins. Instead of trusting our own research, we start trusting other people's opinions. The problem is, the stock market doesn't reward people for being comfortable. It rewards people for making well-informed decisions. When your investment is based on someone else's confidence instead of your own understanding, even a small market correction can fill you with fear and uncertainty. Warren Buffett has never allowed public opinion to control his decisions. He understands that the market often becomes irrational. Sometimes people become so optimistic that they push average companies to unrealistic prices. At other times, fear becomes so powerful that even excellent businesses are sold at huge discounts. Buffett doesn't let emotions decide what something is worth. He focuses on facts, business fundamentals, and long-term value. That's why he is perfectly comfortable making decisions that seem unpopular in the moment. He knows that the crowd is usually reacting to today's headlines while he's investing for the next 10 or 20 years. This is the true lesson behind Warren Buffett's rule number 5, ignore the crowd. It doesn't mean believing you're smarter than everyone else. It means having the discipline to think independently. Before making any investment, ask yourself one simple question. Am I buying this because I've done my own research, or because everyone else is buying it? That one question can protect you from some of the biggest investing mistakes you'll ever face. Because in the end, successful investors don't follow the loudest voices. They follow the strongest reasoning. The next time you hear everyone talking about the same investment, don't rush to open your trading app. Instead, pause for a moment and ask yourself 3 simple questions. First, do I actually understand this business? Second, if nobody else was talking about this company, would I still want to invest in it? And third, am I making this decision based on facts or based on fear of missing out? These 3 questions may seem simple, but they can save you from some of the most expensive investing mistakes you'll ever make. Successful investors don't react quickly. They think carefully before putting their money at risk. Warren Buffett has never tried to impress people by following the latest market trends. Throughout his career, he has remained comfortable making decisions that looked unpopular at the time. He understands that the market rewards patience, discipline, and independent thinking far more than excitement. That's why he spends his time studying businesses instead of chasing headlines. He knows that opportunities don't disappear just because other people are buying or selling. If an investment is truly valuable today, it will still be valuable after you've taken the time to understand it properly. And if it's only attractive because everyone else is rushing into it, then it's probably not an opportunity worth chasing. So before making your next investment, remember Warren Buffett's rule number 5, ignore the crowd. You don't need to agree with the majority to become a successful investor. In fact, some of the greatest investing decisions in history were made when the majority of people believed the opposite. The goal is not to be different just for the sake of being different. The goal is to think clearly when emotions are controlling everyone else. Being an independent investor means having the confidence to wait, research, and make decisions based on your own understanding. Sometimes the best decision is not buying the investment everyone is talking about. Sometimes the smartest move is simply watching, learning, and waiting for the right opportunity. Because the market will always create new trends, new excitement, and new stories. But your money deserves decisions based on logic, not pressure. Warren Buffett didn't become successful because he predicted every market movement. He became successful because he stayed disciplined when others were emotional. He understood that the crowd can be right sometimes, but blindly following the crowd can never create lasting wealth. That's the true lesson behind Warren Buffett's rule number 5, ignore the crowd. Don't let fear of missing out decide your financial future. Learn, think independently, and invest only when your own research gives you confidence. If today's episode changed the way you think about investing, remember that this is only one part of Warren Buffett's timeless investing philosophy. We are breaking down all 7 rules that built Warren Buffett's investing mindset, one episode at a time. In the next episode, we will explore rule number 6, stay away from debt, and understand why Buffett believes avoiding unnecessary debt is one of the biggest secrets to protecting your wealth. Subscribe to Money That Multiplies and continue this journey towards smarter financial decisions. Until then, remember, the crowd follows emotions, great investors follow principles,